Hello, 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 stock fans around the world. How are you guys doing today? My name is Jason Krutzky, and it is a great pleasure to be with you all here today. It is the first day of February. Happy February to everybody. I hope you guys had an awesome January. If you've been bullish over the past month, I'm sure you've had a great month or a great start to your year. So kudos to you. How are you guys all doing today? We are here today to observe the FOMC meeting and press conference from our good friend, Mr. Jerome Powell. From everything that I have read and listened to and observed over the past week or so, it seems that consensus says a 25 bips rate hike is in our near future in about half an hour here. And you know, since it's consensus, since about 98.5 or 99% of the market feels that a 25 bips rate hike is in our future today, it'll be interesting to see how price reacts to the initial announcement. The initial announcement is going to be in about 29 minutes, 12 o'clock my time, 2 p.m. Eastern time. And I'm really excited to kind of see how the market reacts, kind of thinking that maybe we might get a little bit of like I don't know, the market might be pricing this in a little bit. What it seems like is more important is really why we're here, is to hear what Jerome Powell has to say. You know, there are people that say they expect him to be quite hawkish today. There are people that maybe say he won't be that hawkish today, that he might be starting to slowly take his foot off the gas of these rate hikes. I'm curious to know, we got a bunch of people here. We had a bunch of people who were waiting for this to start. So if you were waiting for this to start, thank you so much for being here, hanging out with us today. We do really appreciate it. Please say hello in the chat. I would love to get to know you guys and love to hear where you're from. Also, I'm curious what your expectations are for today. Are you expecting a move higher, a move lower, no move at all? You know, what are you guys thinking? What are you positioned for? Are you positioned at all? Are you the type of trader that would rather just kind of sit it out and wait and see what happens? I'm kind of on the sit it out and wait and see what happens side. You know, these days can obviously be very tricky to play. I've got up here on my chart previous FOMC dates, the past 3 previous FOMC dates. We had September 21st, November 1st, and December 14th here. And you can see what happened after those days. Pretty nasty drawdowns across the board. After those FOMC announcements, you had and I've just got the SPY chart up here. We've got an 8% drawdown over the subsequent week, over the following week after the announcement back in September. You've got a 5.5% drawdown after the move in November, after the announcement in November. In December, we have a 7.5% drawdown after that announcement. And, you know, obviously we've bounced from all of those moves, but the initial move was lower for the past 3 announcements, kind of giving me a little bit of a feeling like maybe this one might go a little bit differently. I don't know. They don't do it always the same way every time. And if the past 3 moves have been pretty gnarly, maybe this one will be gnarly in a different way. I don't know. What are you guys kind of thinking? EH, what's going on? How are you, EH? Robert Brush, it's good to see you, sir. Ben Krupa, what's up, man? Good to see you. We got a bunch of repeat folks here. Geronimo, how's it going? From Argentina. Awesome. Robert, what's up? Oh, Ari said hey to you. Joe, nobody. How's it going, man? Good to see you. It's been a moment. You want to see 50 bips. Do you really? Interesting. Why do you want to see 50 bips? EH is positioned for a move higher, but probably will trade it down if the move calls for it. James Owens, what's up, man? From Portugal, looking for 25 bips. Yeah, curious what y'all's thoughts are. Bunch of y'all here, so thank you so much for tuning in. I wanted to spend a little bit of time. Now, we got an announcement in about 25 minutes, so we've got a little bit of time to kill here. And in that time, what I kind of wanted to show y'all, what's up, Braden? How's it going, man? What's up, Matt P? Started following you because Hackerman Ace. Nice. Well, thank you so much for the follow, Matt. We really appreciate it. Happy to be here with you. If you do not already subscribe to the TrendSpider TV channel, please do so right now. We're going to be getting back into the swing of doing more live content, more shows, these sorts of things in the coming months. We have had our heads down working on a big project for the company in the month of January, but that project is starting to kind of find its end, sort of, and so we're going to be going live here more, hopefully come February, March time. So please give us a like and subscribe. We'd love to be on your radar for the next times that we're going live. But what I wanted to do was, in the time between now and the announcement, I wanted to take a little bit of time and go through some of the auto analysis tools that TrendSpider offers. Now, I don't know how many folks here are TrendSpider users. I'm going to assume that there's probably a decent chunk of you guys who are TrendSpider users. So if you're a TrendSpider user, you are probably familiar with a lot of these tools. I might be boring you for the time being, but maybe I'll teach you something that you don't quite know yet, or maybe I'll show you something that you haven't used. But one of the big goals of TrendSpider is to create tools for you that make your analysis easier, and not just easier, but take your personal opinions out of the equation. You know, one thing that we do as traders is we love to predict. We love to say, well, we think it's going to do this, and then it's going to do this, and then it's going to do that. And what that ends up breeding is a little bit, at least to some degree, I'm sure you guys have felt this. I know that I have. It's kind of putting the chart in a place where it kind of resembles what we think is going to happen. You know, we draw our trend lines a certain way based off of if we think the move is going to go higher or lower, or we draw our fibs from a particular swing area or a section of the chart that we feel like is relevant to our idea. And sometimes what that does is it causes us to falsely analyze charts, or it gives us, we're putting our opinions on what we think, or we're allowing our opinions to kind of cloud our analysis. And one of the big goals of the TrendSpider platform is to give you tools so that you don't have to bring your opinions into it. You can just rely on the math of these tools to show you what you need to know. So these auto analysis tools are, you know, they're really great for new traders who are not super familiar with how to draw trend lines or fib levels or whatever. But they're also good for seasoned traders who want just an easier tool, or want to, you know, maybe are looking at the strategies that they used last year or the year before, and they're realizing there are some holes in those strategies, or they're realizing that they're letting their opinions or their egos get in the way of their analysis. So that's what these tools are used for. So what I kind of want to do very, very briefly is go over SPY QQQ just to kind of see where we're at per the analysis tools. And then I want to spend some time, I'm not sure if we're going to have the time now before the announcement or after the announcement, between the announcement and when Jerome speaks, or maybe even after Jerome speaks, I'm not really sure. But, you know, we've got Apple earnings, we've got Amazon earnings, and we've got Google earnings coming up this week. I believe it's Thursday after hours. 3 huge names. Those names are going to have a ton of an effect on the market. And I want to spend some time and use these tools to look at those names. And I also want to kind of play around with some strategies, maybe do a little back testing and see if we can find something that's relevant for us, kind of see how that scenario has performed over time. I was actually testing something on Apple earlier this morning that I found very intriguing, and I'll show it to you guys later on in the show. I'm going to catch up real quickly with y'all. Let's see what's going on. Matt P, no problem. Horses. What's going on, horses? How are you? 50 bips for Joe because Treasury bill will get a greater yield. Okay, good reasoning. Ben Krupa, any interesting options plays to take advantage of? It's a good question. I don't know. We could look into it. Robert Brush, James Owens, user since you first started 4 years ago. Nice, man. Thank you so much for sticking with us. New to the system, still trying to figure it out. Okay, so Bull Cephas, this is going to be for you. What's up, Joe? Genero, how's it going? You're right, EH. It is okay to have biases if you're aware and you protect it. That's absolutely totally fine. I agree with you. It's just, sometimes these biases can change how we view a chart. And so let's talk real quickly. Let's talk real quickly about these tools, and let's talk about SPY QQQ. So I'm just going to stay on SPY. One thing that I noticed this morning, actually, because I haven't really looked at this in a while, but I've got market breadth pulled up here on the bottom of my chart. And this is an interesting tool to keep on your charts. You can filter market breadth in a ton of different ways. I've got it on the net new highs, the net 52-week highs lows. So this is just telling me, how many names are making new 52-week highs versus how many are making new 52-week lows. And something that I have found, and as we go through the charts, we'll see, if I zoom out here a little bit, like we're seeing something that we haven't really seen on the 52-week high note. We haven't really seen this in a while. Essentially what we're looking for here is we're just looking for this number to be above the zero line. When the number is above the zero line, these are good things happen, right? You've got more names making new highs than making new lows, and this is 52-week highs. And obviously when you're in an uptrend, you can see kind of how the chart looks. Now we do kind of look a little bit for divergence in this tool. If you've got a bunch of names making new highs, but price isn't making new highs, or you've got a bunch of names making new lows, but price isn't making new lows, would be an example of divergence and something that we kind of look for. But we haven't really seen price holding above, or we haven't seen names holding above this 52-week high line in quite a while. So it's cool to kind of see that it got above it, it came back, retested it, held it, and it's still holding it. If we look back in time, we see it get above it here and it breaks down below, gets above, breaks down below, gets above, breaks down below. The last time we really kind of saw it hold was kind of back in here in June of 2022. And maybe you could even argue that what's going on right now looks almost a little bit more like April of 2022. Now, of course, we know what happened after April of 2022. So this is one gauge that you can utilize to keep an eye on things and just know as we're making new highs here, do we have more names participating in the making of new highs against the index making new highs? But this is not this isn't technically an auto analysis tool. It's found in our other data tool. There's a bunch of stuff in here. I would recommend playing around with all of this stuff, turning it on and just seeing what it all kind of does. Because again, these are things that you're going to glean and understanding. We're just trying to develop an understanding of where price could go and where it is relative to where it's been previously. So I'm going to throw up some auto fibs here. Auto fibs are going to measure a fib sequence on essentially the most relevant move, right? So from the August 2022 swing high down to the October 13th, 2022 swing low. And where are we trading within that area? I'm going to remove all these guys because we kind of know what's going on here with all of the old FOMC dates. What are we doing? We're holding above the 50% retrace. We're holding above the 61 point or the 0.618 retrace. The farther we get towards these highs, the more likelihood of us going and gaining them. So this is what you really want to see. You're wanting to see these 50% retrace. You want to see it gain it. Originally, when it tested it, it failed it. Then it gains it, it holds it, and then it fails it. And then it gains it and it holds it and actually makes new highs. So this is all constructive, right? This is what we want to see. If we throw up our trend lines, again, like I talked about, trend lines are, there's a lot of opinion that goes into drawing trend lines. Where you draw a trend line from, are you drawing it from the highs, from the close, from the lows? Where are you drawing it from? This takes that guesswork out, and you can define that sort of stuff. You can define, if you click on the three dots, you can define where you're drawing the trend line from, the wicks or the bodies. You can define how many trend lines you're going to see. There are no rules here as far as what's the best to choose. Original is going to show you a few less lines. Standard is going to show you a few less lines. Enhanced is going to show you a few more lines. It's really up to you. From here, you can still have a little bit of discretion as to what trend line makes the most sense to you. I like to keep it on kind of a very basic view, just just kind of simplifies things for me. On the chart pattern tip, this is a relatively new tool to the platform. We have auto discovery for specific chart patterns. If you click the three dots next to the chart patterns button, you'll see double tops, double bottoms, and then multiple different triangles, ascending, descending, and symmetrical. So you can see the platform is identifying a potential double bottom here on SPY chart. Obviously these, let me turn off fibs real quick and let me turn off trends so you guys can see this better. Kind of a cool little tool to be able to just gauge. Again, there's a lot of discretion when it comes to drawing chart patterns. This is going to utilize math to create those chart patterns for you. So, of course, we are not yet above the apex in between those two lows. Platform is identifying these bad boys as our two lows, right? Oop, wrong spot. Right here and right here, right? So we're trying to get above this level, this 431.96. That's going to really kind of, if we can get above that and hold that, then that's going to solidify this as a proper double bottom. And the platform is automatically identifying it for us. The next tool is the heat maps. And this is one of my favorite tools. There are not a ton of tools out there, period, for traders who are price action traders, levels-based traders. This is one tool for traders that are interested in those things. So what this is doing, it's looking for areas where prices made the same highs or lows over a period of candles, essentially consolidation in a tight range. When it finds it, it plots heat maps from that level, extends them forward. You'll notice there's a gradient in the heat map. The darker the red, the bolder the red, the more powerful an area may be. As it extends into the future, it tends to dull. So as it dulls, that level becomes less and less powerful. Over time, it becomes less and less powerful. So the brighter, the bolder the red, the more powerful it may be. The duller the red, the less powerful it may be. These levels can act as levels of interest, whether it be support or resistance. They can be, if price is above them, then you're going to look to them as potential levels of support. If price is below them, you're going to be looking for them as potential levels of resistance. And, what I'm kind of looking for all the time is I'm looking for a combination of these tools lining up. I can see I've got a 0.786 fib extension here, and I've got it in tandem with a heat map area that's giving a little bit more confidence to the idea that if we do move higher, you might find a bit of a break. You might get a bit of a pause at this 414.50 level. But, all in all, based on what we just kind of went through, and we did that very quickly, right? It didn't take us very long to do that. All in all, things are looking pretty constructive on SPY. So that's kind of my very, very basic thoughts. Again, we're not trying to pinpoint where price is going to turn. We're not really trying to develop a very, very specific sense of what to do, but we're just trying to develop an understanding of kind of where we are on the chart, technically speaking. Now, we do have a bunch of other tools too. If you go to your sidebar, you say add or remove and add new widget. Got a ton of tools in here that you can use to, again, further gauge what you think, or further gauge an understanding of what the markets are going to do. We've got analyst estimates here. Of course, that's not relevant for SPY. We've got seasonality. That would definitely be relevant. We'll take a look at it. We've got unusual options as well. Let me see. I might throw some other things up here, even though we can't really use them on SPY. I'll just go ahead and throw news up real quick. So on the seasonality tip, this gives us an understanding of how the stock performs over a period of time. You can filter by month, by week of the year, by day of the week, by hour of the day. I saw that our CEO, Dan, posted this earlier today. This is kind of interesting. So historically, what we're doing is we're looking back and we're looking for just green. In this case, we're looking for green weeks. We're looking back to 2023, and we can see that 45% of the time this week since 2023 closes green. However, 68% of the time since 2023 next week closes green. Since 2023, the week after next, 84% of the time. This is the strongest week of the year, is in 2 weeks from now, the strongest week of the year. Maybe not the strongest week of the year. That might be a little misleading. This week has the most green closes since 2003 of any other week on SPY. That is a very, very interesting data point. And you could make the argument for simply buying into this weakness. This week is historically weak, or not that weak, but 45% win rate. So not 50. And the next 2 weeks tend to be very, very strong, specifically 2 weeks out. So that's kind of interesting. We'd have to look into why that 7th week of the year happens to be the strongest week of the year historically over the past 20 years. I'm sorry, not 2023, 2003. So the date, I'm sorry, you guys, I didn't mean to confuse you. Since 2003, so this is looking back on the weekly time frame, we're looking back to 2003. So since 2003, the 7th week of the year, just 2 weeks from now, historically is the strongest week of the year. That's a really, really interesting interesting data point. I apologize for the confusion, you guys. If we go to unusual options, we see something totally different. We see a ton of volume coming in what does this say to you? You've got green circles that denote call buying. You've got red circles that denote put buying. So the market is heavily positioned to the downside here over the past 200 or so unusual options prints that have come in. You can filter these out in a number of ways: by date, by premium size. We can adjust the strike price as well. But when we keep these things just completely open, we see some really, really strong positioning to the bearish side. This is not generally what you want to see if you're bullish, right? This is a pretty gnarly positioning here. So again, we're just using these tools to develop some sort of understanding of where price might head. If we pop over to the Qs, we can do a bit of the same. We're coming up on 9 minutes until the announcement here. So in a couple of minutes, I want to switch over, or well, actually, if you guys can, hit me with tickers that you're interested in watching. I'm always curious to know, would you guys prefer to watch a bunch of tickers, or would you prefer to watch like 2 or 3? Yeah, EH, I'm not really sure what that is. It's definitely one thing you have to consider is that it's the past 200 prints. So it's very possible that those 200 prints came in. We could look at when they came in. It's very possible those came in over the past day or two, and it could be hedging. We don't really know. We just know that that's the positioning right now in the near term. Tesla rig. Yeah, do you guys have an opinion, a preference to multiple names or just a couple? I'm going to use our multi-symbol view to kind of watch a bunch of stuff. But let's pop over here. I'm on the Qs real quick, and I'm going to go to the NMS, switching out the market breadth here to the NMS. And again, kind of the same look, right? This is the first time in a long time that we're seeing net new highs at least staying above this zero line. We haven't really seen this be able to stay above the zero line, even though it's just kind of hugging it. We haven't been able to see, or we haven't seen this really since November of 2021, right before markets tanked. So this is a fundamental change in net new highs, 52-week highs. It's something to really consider, I think. If we go to the auto analysis tools, obviously Qs are just stuck here at that 50% retrace from this previous important swing. So that 50% retrace, even though it's been tested a bunch of times, it's clearly resistance. If prices can get above it, that's going to represent a very important change of trend, right? That we're able to actually get above it. You would want to, of course, see it come back in at some point and hold, but the fact that it's tested it a bunch of times kind of suggests to me that it's going to lose its power eventually. If we get some sort of bullish print here, this could be a real change. This could be a big turning point for Qs just on this very simple, fib level. If we go to trend lines, same thing, right? From the all-time highs, we're finally We're finally breaking above just this downward sloping trend line. It's an important change of trend. It's something that we really need to be mindful of, and it's helping us build our case for why we want to be long, or if we want to be short, it's helping us build our case for why we want to be short. On the chart pattern signs, same deal. We've got that double bottom being discovered here, and a little bit different of scenario on the Qs than on SPYs, that we're actually above that apex line. We're above that middle point between the two lows. We did get above it here, and then we failed below, but we held the low, and now we've gotten above it. So we might be looking for this area to come in and act as support at some point. You could argue that they tested it here and it held and they went higher. So something to watch out for. And then of course the heat maps. We've got the heat maps, potential levels of support and resistance, again, based off of previous horizontal consolidation. And so, if price is able to push higher, you've got a gap here, you've got a heat map level here. So we know that there are potential for sellers at this 304 level. If we get a nice move higher, this 304 level might come into play as a potential area of some profit taking. On the seasonality, real quick, I know we've got only a few more minutes. Same story on seasonality, but it's actually next week for the Qs. Next week, since 2003, not 2023, since 2003, next week is generally the strongest month or strongest week of the year. Since 2003. It has the highest success rate, highest win rate, highest chance of closing green of all of the weeks of the year. So it's really interesting. It's kind of, again, just trying to build a case. On the unusual options side, let's pop over to unusual options. Not as clear of a picture here. We saw SPY. SPY was very clearly pretty much just bright red everywhere. Well, the Qs quite different looking. What I like to do whenever it's a little bit less clear, I'm going to take this down. So what I'm doing is I'm adjusting the expiration date. So I'm just looking out to like March, February of this year. So this gives us a bit more of a microscopic view, a closer view. We're only taking into account short dated options here, or relatively short dated options out to essentially March. So initially, on the front end, this is the immediate. These are going to be closing in the next day or two or three. We could see these expire on the 3rd. These expire today, and so on. So the positioning is a little bit more even, a little bit less sure on the Qs than seemingly what was going on SPY. Okay. We're a couple minutes. Let me throw some tickers up here. I see some names that we want to add. Okay, so I've got SPY, Qs. I've got the dollar. This is the UUP, so it's the ETF for the dollar index. I figured you guys might want to watch that. I've got gold here. What else we got? We'll go to IWM right here. Let's see. Align. ALGN. We'll throw that up. HYG. Tesla. We'll go to Tesla and see what's going on with Tesla. CHPT. Just cruising through, looking at y'all's names here. Coin, Sean. Let's hit coin. This is a good crypto proxy. Yeah, well, SQQQ. I mean, SQQ. Well, I'll throw it up there. We've got Qs up here, right here, just so you are aware, so you can see that. But I'll throw up SQQQ for you. PXD. So we can do up to 16 names, but I kind of want to keep this thing. I want to make it so that you can actually see them all. All right, announcement. 1 minute, guys. It's the 1 minute warning to the announcement. We are about to get the initial move. Expectations, what do you guys think? Higher, lower? On the initial move. Taking guesses. Higher or lower? I kind of think lower initially. Joseph, 0 bips. Greg says higher. Joe says lower. Bull says higher. Lower than higher. George, I'm with you. I say lower than higher. Or lower than higher. Mimi, you say lower? Okay. Sean says lower. Joe Genero says we are going to rock. One way or another, yeah. Duke is looking for higher. Yeah, James, that's kind of where my head's at too. Because the market the market pretty much knows. So then you assume that maybe it's priced in, and then it's up to Jerome to come in and like make it move. I think really what people are waiting for is what Jerome has to say. But we're about to find out. Looks like initially they're trying to front run it a little bit. Yeah. So it may be a muted response since the market does know 25 bips. Yeah, so 25 bips. And relatively muted response so far. I'm not seeing anything too crazy here. Right, Joseph, exactly. Already priced in. What isn't priced in is what Powell is going to say. We just don't know. You know, is he going to come off more hawkish than usual? Markets have been gaining lately, and we know that he's not loving that the markets are gaining lately. Or is he going to maybe come off a little bit more dovish? Is he going to be okay with markets gaining? Does he feel like we're hitting the targets that they're really looking for to be hit? This is an incredibly muted reaction. I mean, relative to like the past couple, this is very, very chill. I guess SPY's moved, what, $2? You guys seeing anything out there that's of interest that's really moving right now? I think we're going to have to wait. I think we're going to have to wait for the presser. Commodities could really move if he's hawkish. You think he's going to be dovish, Bull? Yeah, I just don't know. I think I think it could go either way. It doesn't feel super clear to me. The past couple of times I've watched him, he seemed less rigid, I guess, would be a way to describe his tone. Like he seemed pleased with what he's seeing the past couple times I've seen him. To everybody who's just tuning in, thank you so much for being here. We have the Jerome Powell press conference. It's going to be live in about 30 minutes. I've got it here. It's going to be above me right there. You can see it now. And we're going to be tuned in to him. So if you were thinking about watching the Jerome Powell press conference, look no further. I am going to shut my mouth when he comes on, and we are just going to listen intently to everything he has to say, and we're going to watch the markets to see how they react. Short-term T-bills running higher. Okay. Joe, thanks, man. I appreciate it. All right, so in the meantime, you guys tell me. I'm happy to stay on these charts, but clearly the markets are kind of not participating yet, right? The markets are still just waiting for Powell. So if if it's okay with you guys, I'd like to pop back over to the single charts and have a look at Apple, Amazon, Google. You guys into that? Is that a-okay? Let me know if that's cool. Otherwise, I'm happy to stay on these charts so you guys can just keep an eye on all of the individual names. But I'd like to take a look. Yeah, all right, sweet. We got 3 yeses. Let's go over to the individual charts. I'm going to go to Apple first because, of course, we got to take a look at Apple. Turn all these bad boys off. So let's first, auto fibs. Can't really mess with anything until we take a look at auto fibs, but we will take a look at everything here that we can take a look at. On the auto fib side, up above the 50% retrace from the recent or the most relevant swing that we are contained within, meaning price is in between that high and the low. So we're contained within the swing and we're above that 50% retrace. Looks like we kind of caught a little bit of resistance on the 618, coming back in to test the 50. Pretty constructive to me, but you know, we'll have to see how that plays out. That's a first initial thought. If we go farther out here, I'm going to switch. Well, if we go farther out here on the shorter term, auto trends, what do we see? On the shorter term, you've got your green trend lines here. So we're breaking above this kind of, what would you call this? Just like a triangle area here. But the longer term trend is still intact. We're still below this longer term trend line. So something to keep in mind is that we are still below it and it could come into play at some point. As I'm a price action guy, I don't know, how many people here are familiar with me and familiar with my trading style, but I'm a price action guy. For me, this lines up really nicely with these previous highs from back in December. It would make a lot of sense for price to come in, tag, maybe reject initially. Once those highs, you got to assume that there's a bunch of highs hanging out, or there's a bunch of stops hanging out over there at that previous high around $150. I know $150 was kind of the line in the sand for a lot of traders. So not a surprise to see longer term trend lines around that level. So important to keep in mind. If we go heat maps here, see what the heat maps are finding. Again, we're using all these tools to just kind of gauge some understanding. Looks like no heat maps up here. That's kind of interesting. If you don't find any heat maps, you can always go to a lower time frame or a higher time frame and see if it discovers them. Sometimes it just doesn't find them. Yeah, so here's a few. And again, heat maps at that same level, that 150 level. This is on the 4 hour. So that 150 level, clearly a very important level. And something to keep an eye on for Apple earnings. We can go chart patterns, check out what's going on with chart patterns. I'll go back to the daily here. So this is kind of interesting. We ended up taking out these lows, but got them back. So really, again, another kind of area that, or another auto analysis tool that's kind of pointing to the same area, that 150 area. 150, clearly, very, very important. 4% plus on fangs. Interesting. That's good to know. Let's check out. Hold on. Are markets moving without me? Oh, they are. Dang. Okay. Interesting. Everything gaining. Dollar's gaining too. The only thing not gaining. Sad, poor SQQQ. I'm going to switch one of these to FNGU. Hopefully that's okay. I know I could add more, but again, I just don't want them to be so small that you guys can't see them. Well, that's interesting, guys. They certainly held things. All right. Okay. Y'all let me know if anything crazy happens. I'm going back to Apple real quick. On the unusual options side, let's take a look at how options are positioned. We definitely want to know that. Here we got options. I'm going to pull this in and we're just going to look up through March. Actually, Let's even pull it in tighter and just look at February here. So February, options look pretty dang bullish to me. Really not much there on the bearish side, on the unusual options side. Again, it's the past 200 orders that fit the unusual options criteria, but still something to keep in mind about. So unusual options are positioned more bullishly. That's cool. Let's check out seasonality. Seasonality, same deal. Same deal we're seeing on Apple as we saw in the Qs. Pretty strong week of the year next week, the 6th week of the year. 74% win rate since 2003, not 2023, 2003. 74% win rate. The only better performing weeks, week 17, I guess that's in, what's that, like May-ish? And then week 33, the 89% win rate. This must be like around, I don't know, quarter 3 earnings maybe? I don't know exactly. But an interesting data point anyway. This is a very strong week of the year historically for Apple. On the individual equity side, if we go to add or remove widgets, I'm going to add one other one here, the analyst estimates. Again, analyst estimates are not available on the ETFs, but they are available on individual equities. So this just gives us an idea of how the street feels about any particular symbol. You can see this in two ways on the platform. You can see it in the sidebar here, like I've got in the widget. To me, the more efficient way of reading it is in the other data area. So we go other data and we add analyst estimates. We'll see them on the chart here. Let me switch to the daily. So you can see analyst estimates down at the bottom of your chart. Just gives you a visual representation of when they've made their estimates. For anybody who's new to the platform, doesn't know what these are, you're going to see green Bs, you're going to see gray Hs, you're going to see red S's. So that's buy, hold, sell ratings. If a box is all one color, that's a reiteration of a previous rating or of their most recent rating. So very, very recently on the 23rd here, we've got a couple of people who have reiterated Apple as a buy. If it's an upgrade or a downgrade, the box is going to be half one color, half another. So like, for example, this little guy right here is green on the left-hand side, gray on the right-hand side. Because it goes green to gray, it goes left to right, that's a downgrade because green was buy, gray is hold. So this particular analyst, we see Jerome Powell from Exane BNP. I don't know exactly what that is, some sort of group. But he's downgraded Apple. So just getting an understanding of how the street feels about a name. You know, obviously you want to see reiterations. You don't want to see, or you want to see reiterations of buys, or you want to see upgrades from hold to buy or from sell to buy. To feel a little bit more bullish, you want to see downgrades. You want to see reiterations of sells to maybe feel a little bit more bearish. And it's just a nice visual companion that you can throw up on your charts and have living there to let you know whenever a new analyst estimate comes in and what they've said. So I don't know, Apple feels a little bit mixed to me. Apple feels like that 150 level, all of the auto analysis tools are pointing to that 150 level as a really, really, really defining important level. And we could see it's had trouble there, you know, ever since it kind of really lost it. It tried to gain it to some degree kind of back in October through this price action here, but ever since it really lost it, it's been having trouble there. So to me, that 150 level is going to be really, really vital and one to watch. So that's what we're thinking about Apple. The overall indices are kind of suggesting that if it's going to run, now's the time. You know, you've got net new highs in the positive. You've got the strongest weeks of the year coming, or some of the strongest weeks of the year coming in the next 2 weeks. We go Amazon. Let's take a look at Amazon. It's interesting to see the difference when you pop through different names, like something like analyst estimates. Like, look at how many buy reiterations came in back in November when this thing was making lows. I mean, it's pretty impressive, just the sheer amount of participation from these analysts and how confident they are in this particular stock. If we go to auto fibs, I need to update. So this is a good lesson real quickly. All of our auto analysis tools, they do not automatically update. And the reason why is because we don't know, we don't want to assume that you're not using them based on how you want to use them. So in order to update them, you need to press the refresh icon here in the top left corner of your chart. When you do that, all of them are going to update. That means your auto fibs are going to update, your heat maps are going to update, your candle patterns, your auto trends, all that stuff is going to auto update and give you the most recent, the most relevant analysis on your chart. So quite a bit of work to do here on Amazon. Very clearly, we are at the bottom end of this fib range or this swing. That 50% retrace 114, probably going to end up being a pretty important level. You've got a nice big gap to fill. They look like they're setting it up to potentially come in and try and fill that gap. If they do, this would be a logical place for them to pause. We'll see. Just looking at y'all's notes real quick. Rashad, the golden age is upon us. Congrats to longs. Any way to get company profiles? So like internal, are you talking about like internal fundamental data? EPS and just like balance sheet type information? If that's what you're talking about, I do think that data is going to come. I can't tell you when that will come, but I do think we'll bring it to the platform eventually. So you've got a nice gap above. Obviously, that's going to be important. And they've come into it. They've tried to test that level a lot. Obviously, 103, 104, huge support here back in June last year. And now huge resistance. So it would make sense if this thing has a killer earnings that they might pop through that and fill that gap. And so that 50% retrace might be important. Pop over to the trend lines here. Trend lines are on some interesting stuff. This is why these tools are interesting to me, because they just draw based off of sheer math, the strongest occurring trend lines on the chart. And two of those are two that I would not have drawn personally. On my own. If we switch to weekly, let me do this. We get that's kind of an interesting view too. Another reason why these tools are kind of cool is because, they just think about things it wouldn't necessarily be my first train of thought to be drawing off of all of these lows, but clearly an important spot that price might come up into and find some resistance. So let's pop over to chart patterns, see what's going on with the chart patterns here on the daily. Interesting. This is not what I would have drawn either. So we're reclaiming previous lows from June for the first time. First time, mind you, since we've lost them. Looks like they were perfect support today, actually, on the lows today. Interesting. It's kind of maybe a very short term, at least, change of trend. We're going to go to chart patterns here. Or rather, I'm sorry, not chart patterns, heat maps. Heat maps showing just a couple of levels of support below. We go to a different time frame, take it a little bit lower. Again, like I said, if you're not finding what you're looking for on a certain time frame, try adjusting your time frames, and you might find something else. So again, same kind of deal. A lot of potential support below and a lot of air between the next heat map area. If we look at unusual options, how are unusual options positioned? Just going to the end of February. Looks like very, very near term, end of this week, lots of bullish positioning. Quite more bullish positioning and bigger sizing too. The size of the circle is relevant. The bigger the circle, the bigger the order size, the bigger the premium. So quite bullish positioning here, at least into the end of the week on Amazon. Does it have the same seasonality? Not quite as strong, but definitely one of the stronger weeks of the year coming up here in about 2 weeks. 68% win rate on the 7th week of the year. There are several other weeks that have that kind of win rate. Looks like summertime, Middle of the year is kind of the best performing weeks, or the best performing weeks are in the middle of the year. Let's say that. Market is whipping around, running stops. Let me go back to Qs real quick. Take a quick look. Oh, it is, isn't it? Everybody's just waiting on Jerome. We're all just waiting on Jerome. Jerome's he's gonna do what he's gonna bring the move, is my opinion. Google. Let's take a look at it real quick while we have a little bit of time left. Throwing auto fibs up. Again, need to refresh. Interesting. I'm going to go to, since we're right at the top of this range, I'm going to go to a bigger time frame. Yeah, this is kind of more what I was thinking. See, there's still room to have discretion, you know. This 50% retrace from this swing high back in August last year. It's a big level. Could act as some resistance here. But the fact that they've tested it so many times already kind of leads me to believe that if there is a powerful move, they could burn right through it. So then your next one is the 0.618, 108. That aligns with the July 4th, or like, I guess this is like May through July of last year lows. Pretty logical spot to maybe find some resistance if we get a move higher on Google. Go to trends, see what the trends are doing. Pretty much from all-time highs, we are just hanging out. So many charts at like big pivotal spots. Trend line from all-time highs, downward sloping trend line from all-time highs. Big spot here. So a fundamental change of trend, if we're able to get up above it, come back, test it, hold it, will be interesting to see. Chart patterns, what do we see here? Not super relevant, but that low is important. That 103, that low is important. And then the heat maps, a lot of air between the two that we could see. So I'm going to go to a smaller time frame. And there we go. Big one at $100. Kind of like Apple at 150. Amazon at 100 kind of feels like a pretty decent psychological spot that really needs to get gained. So some similarities. Or I'm sorry, did I say Amazon? I meant Google if I said Amazon. What's up, Sonia? Good to see you. Hustle Broke, what's up? I'm going to unusual options now. We're just looking at this week. Or rather this month. Pretty even positioning, really. 115 puts. What's this big one? 101 calls. 225K in premium. Kind of even look here for Google. If we look at seasonality. Interesting. Since 2014, Google 33% win rate this week, jumps to 50 next week, jumps to 75% win rate in 2 weeks. Relatively even distribution on these values, though not as clear as some of the other symbols. There's an alarm going off in the background. Okay, so we are at 7 minutes until Jerome joins us. Joseph, we'll see you in 10 minutes. Enjoy your break. And pop back over to the multi-symbol view here. And just kind of get a feel for what's going on. What's up, Arjun? Some love back at you from Colorado. What's up, Bradley? How are we doing? Hope you're well today, sir. Brad, what you thinking, man? What you thinking about Jerome? What's he going to tell us? Is he going to give us the goods? Is he going to deliver? Up only? Very curious to know what you think. I feel like everything we just went over, Google, Apple, Amazon, I feel like they're setting up. Definitely not smart enough. I mean, I was hearing talks this morning of the potential for like maybe one, maybe two more rate hikes, and then potentially them starting to cut again. Which would be crazy. Do I believe in the FOMC strategy? Sean, what's the FOMC strategy? Hit me with it. By the way, y'all, I've got, like I said, I've got Jerome rocking and rolling. Oop, let me put this back up. I got Jerome rocking and rolling here, but sometimes this video feed above me is late. So if you guys happen to notice that he's live and I'm not on it or he's not here, please do let me know. SPY 410 close above the weekly. Let's take a look. So you're looking for a weekly close above there. Yeah, you could totally do that, Brad. I definitely have done my fair share of that. I actually really like to do that, but I can't do that right now. All right, Sonia. Have a good one. What did you say? Hold on, I need to look at your target. SPY intraday target 407. Long term. 365 too. Yeah, the only problem with doing that, Brett, is you got to be quick. I mean, you can have everything pre-staged. Sure, you can have your offers and your bids, and then the limit orders on the other ends. But every once in a while, I've had it one time happen to me where like price just ghosted through all of it. Didn't get fills, didn't get anything. Okay, so Sean, FOMC strategy. First major move at 11, then reversal move when he speaks. So the thing is, I mean, yes, it's been volatile. How big was this move? Interesting, price came right into the heat map level here on the very small time frame. How big is this move? Yeah, almost 1%. I don't know. I think whatever Jerome has to say, that's going to be the thing. Cheers, Brad. Appreciate that. Hopefully we get a few more people in here. I want to, before Jerome goes on, he's about to go on. Before he goes on, I do want to say, anybody who's a TrendSpider user, hang out through Jerome's speech. I want to spend like a few minutes and talk about strategy testing. We don't talk about it that much here, but we're going to be talking about it a lot soon. And I want to spend a little bit of time talking about strategy testing. Kind of want to show you guys some little things that I've found and just some alternative ways to utilize the platform to, again, continuously make your analysis a little bit easier. So stick around till the end. I'm going to spend a little bit of time in the strat tester just talking through different ways that you can utilize it. What's up, NSM? How's it going, Bubba? All right, we got to get Jerome in here. I'm going to, let me turn off this music. Let me turn on this music. All right, so just let me know, guys. I'm pretty sure you should be able to hear. You should be able to hear and like loud and clear the Jerome Powell music. Can you guys all hear that well? There it is. What's up? Okay, thanks, Braden. When he's at the podium, sell. When he stops talking, reverse. I mean, that's one way to do it for sure. I'm going back. Oh, well, no, I got to stay over here. Well, no, I don't. I'm going back here. If y'all got tickers you want to watch, hit me. We can change out some of these. Elevator music, loud and clear. Yes. This is the way. Like I said, though, sometimes they're late to pushing the stream here, even though this is their website. Sometimes they're late to pushing the stream here, and it's on YouTube first. So, like I said, I've got YouTube loaded up too and ready. We got CVNA, don't we? No, we don't. All right, I'm going to change out SQQQ. My man really wants to see CVNA. Holy cow, look at that thing. That's the biggest mover of the bunch. Baidu. We'll throw Baidu up. I got you. Oh, PXD, I just removed it. It was down here in the bottom right-hand corner. All right, Jerome, where you at, homie? He's on. See, this is what I'm talking about. All right, well, let's do this then.
The economy does not work for anyone.
Okay.
In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals, as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris Rugaber, Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your I'm sorry.
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil. Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually we're close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature, it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is, research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to we have to complete the job. I mean, that's what we're here for.
Nick Timmeros, The Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above-target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria?
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization, in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina, and then Steve.
Gina Smilek from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? You know, could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, you know, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and I mean, you saw what the Bank of Canada did, and you know, they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, you're right. If you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now. But that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down, and I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. You know, it's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and you know, my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think, you know, most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with you know, money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year, and that's my base case is that there will be positive growth this year.
Rich.
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence metric?
I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And you know, the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, It's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. We're not, market participants have a very different job. And it's a fine job. It's a great job. I did that job for years, but in one form or another. But, we have to deliver that. And so we are strongly resolved that we will, complete this task because we think it has benefits that will, support economic activity and benefit the public for many, many years.
Edward.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come, to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down and Congress did what it did and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
So my forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. If that happens, if inflation comes down much faster, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
Thank you, Chair Powell. Simon Abrinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession, and we have inflation moving down. Into somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if we get if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Scott.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the
Order
points
filled.
you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
Stop field.
That's the general sense of it. Look, we understand, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we've kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time, but we thought that, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's monthly or post-meeting statement as an ongoing economic risk, as opposed to a health issue.
Nancy. Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Wanted to go back to another thing that Fed Vice Chair Lael Brainard said recently. She said she doesn't see signs of a wage price spiral. And I'm wondering if you agree with that.
I do. Yeah, I do. You don't see that yet, but the whole point is, once you see it, you have a serious problem. That means that effectively, in people's decision-making, inflation has become a really salient issue. And once that happens, that's what we can't allow to happen. And so that's why we worry that the longer we're at this and the longer people are talking about inflation all day long, every day, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient. And people are, we pick that up in conversations, and I've seen some data too that show people are, gradually, they're glad that inflation's coming down. People really don't like inflation. And as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and, high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even, you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses essentially we believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. And in this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Greg.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast. But our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer, faster to that drop-dead debt ceiling deadline? Could it play an effect as we get closer to that drop-dead deadline this summer?
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk, the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
All right. Well, there we have it. What'd you guys think? Was it what you expected? Was it not what you expected? Curious to know everybody's thoughts. I'm not sure how I feel about it, honestly. But I'm curious to know what you guys think. We're going to hang out for just a few more minutes in the chat. I posted a link to a 35% discount code for the TrendSpider platform. If you are not yet a TrendSpider user, but you are interested in checking out the platform, playing around with the tools, seeing how they can help you with your trading and your technical analysis and your understanding, specifically your understanding of your strategies, try that link out. There's no risk to you. And, give it a go. 35% off. It's a great deal. Yeah, I'm kind of going to agree with you guys a little bit. He was maybe a little bit more dovish than I would have anticipated. He seems still very committed, obviously, to the cause, to bringing inflation down. He is not, he sounded like he really tried to squash the idea that there would be a stop to the rate hikes this year, which there were definitely rumors going around that the rate hikes could potentially stop before the end of the year. Dovish with Hawkeyes. There you go. Yeah, so maybe now is the reversal move. Somebody said earlier, fade the opposite direction when he gets off the podium. This could be that move. We can definitely see things starting to reverse here a little bit. SPY pulling back, Q's pulling back, crypto's pulling back, pretty much everything kind of pulling back, but pretty insane run from 404 to at least SPY 404 to 411 in half an hour, 45 minutes or so. So with the next just few minutes, I don't want to spend a ton of time on this, but I do want to take a moment to talk about strategy testing. This is a process that, in my experience, I spent my first year and a half at TrendSpider talking to users and working with users one-on-one every single day, 5 to 7 users a day, helping them get comfortable on the platform, helping them understand how to utilize all the tools on the platform. This is what I did for a long time. And one thing that I found when talking to customers was that in a lot of ways, they were kind of timid about utilizing the strategy tester on the platform. So I wanted to take just a few minutes. I'm just going to use like a really simple strategy, but I want to show you guys kind of what is possible. A lot of people, and I'm sure most of you guys tuning in, you guys have strategies that you utilize every day, and different people utilize their strategies in different ways. Some people are very, very rigid about how they perform the tasks of their strategy. When their strategy says to buy, they buy. When their strategy says to sell, they sell. Some people like to go off of a gut feel on the market, and there's everything in between, right? we are trying to get folks to understand the reality of the strategies that they're utilizing. And one of the easiest, best ways to glean that understanding of the strategy that you're using is to back test it and see, well, how does it perform over time? It's a very simple task to do, and it's kind of overlooked. And we want to like bring it to the forefront. We really want folks to like start here. You know, before you get into a trade, why are you getting into that trade in the first place? Are you getting into that trade because, you know, 5 people that you follow all said they were going long or short that particular idea? Are you getting into that trade because it's worked previously for you? Are you getting into that trade because you back tested it to see? One of the best ways that you can go about getting into trades is first understanding how the trade works historically. So that's why we utilize the backtester. The backtester, if you have not, if you're totally new to TrendSpider, it can feel like a bit of a uphill battle. If you've ever tried doing this on any other platforms, you've probably had to script things or code things. TrendSpider does not require any coding at all. If you can explain it, if you can write the strategy down on a piece of paper, explain it to a friend, you can script it out in Strategy Tester. It's a no coding environment. So I'm just going to pick something very, very simple. You know, so many traders out there have so many different strategies, and you know, different strategies can work different ways. Some can be very complex, some can be very, very simple, and you can get good results out of both. There isn't a right or a wrong way. It's just all about testing and seeing. So I'm going to use just something very simple, a moving average cross. Everybody knows about moving averages. Everybody knows about moving average crosses. Even beginners to trading understand the basic idea of a moving average cross. It's probably one of the first things you learn about. But I want to talk through kind of how to script in the strategy tester, and then I want to talk through the results that you get back so you can understand a little bit more about how to use it for yourself. So when you open up the strategy tester, you've got 2 sides. You've got a left-hand side down here, and you've got a right-hand side. I'll even make it bigger so that you guys can see it a little bit better. The left-hand side is your entry conditions. The right-hand side is your exit conditions. So you first need to define your entry conditions. We said we were going to do a moving average cross. Let's do a moving average cross. To do that, we click add parameter, and we're going to select just the condition option. And then we have to choose what we're defining. Moving averages are indicators, so we'll select indicator. And then we have a list of all the indicators that we can backtest. So I'm going to choose exponential. I'm just going to start typing in exponential, and we get our exponential moving averages. I'm just going to use a standard EMA, and we're looking for it to cross. So we have to then choose the action that it's taking. It could be greater than something, less than something, within range of something. You could say it's increased or decreased. It's crossed, crossed up, crossed down. Lots of different options. Prices touched it, bounced it, off of it, broken through it. We're going to say crossed up. And then what is it crossed up on? It's crossed up on another EMA. So we're going to choose the indicator option because EMAs are indicators. And then again, type in exponential and select it. So now we've got an EMA crossing up on another EMA, but we have to define the EMA lengths that we're referring to. There's a ton of different philosophies on the proper lengths to use. Find stuff that works for you and run with it. I'm going to use an 8 and I'm going to use a 21 because that is a really popular strategy. Buy when the 8 crosses up on the 21, sell when it crosses down. Super simple, right? So let's script out that other side. So we've got our exit over here. And you'll see a number of different options on the exit side. In order to write a script, like we just did here, we click Add Script. And I'm going to very quickly do this. So we'll say condition, indicator, exponential, cross down on indicator, exponential. And then we're going to just change the lengths, 8 and 21. Now we could, if we wanted to, we could add an entry invalidated set of conditions to say, you know, if this stuff is true, we want to get out. We can choose to get out after a certain number of candles have passed. We could choose to get out on a particular take profit percentage. We can choose to get out on a stop loss percentage. We could have these buffer zones on either side of the trade if we wanted to. You could have a trail stop. Completely up to you. There's a lot of stuff to play around with there. I'm going to leave it as is just to be really super simple with it. Next, we need to pick our time frame. Again, everybody trades different ways. Some people are swing traders and they use the daily time frame. Some people are day traders and they use the 1 minute. There's not a right or wrong way. It's just about playing around with these ideas and finding things that work so that you can take the fear and the greed and your personal emotional stuff out of it and commit to the system. I'm going to use the daily here. So use the daily. It ran the test. We're going to keep on adjusting though. Data. This is how far back we're testing. We could test what's on the chart. That's like 300-ish candles. Or we could test back 1,000, 2,000, all the way to 7,000 candles. I'm going to use a 3,000 candle window. So 3,000 daily candles. There's, 250 of them per year. So there's about 10 years of data. And it runs the test. And when we run the test, we get our entries and exits printed on the chart for us. I've got this indicator. Let me throw up real quick. There it is. Let me turn a couple of other things off so that we're not looking at a bunch of random stuff. So this is just an 821 EMA cloud. When the cloud is blue, the 8 is above the 21. When the cloud is red, the 8 is below the 21. Where they cross is where we get in. So you can see our entries are printed, our exits are printed, and so on. And we could go back in time and we can look historically, how does this stock perform when we take these trades? So looking back 10 years, we get our performance, 633% gain on this particular strategy. On the right-hand side, or just to the right, we have the asset performance. This is like buy and hold. If we had bought and held Apple for that same duration of time, we'd be up 1,081%. Now, this particular strategy does not beat buy and hold, but it does do pretty darn well. 633% win or gain over this period of time is nothing to shake a stick at. It's actually quite good. On the right-hand side, tabular data. This is just the breakdown of all of the data points. So you have your net profit, you have your asset performance, you have your beta versus asset, you have the number of positions you took, you have your win rate, 42%, your loss rate, 58%, your max drawdown, negative 27.5%, your average win, 13.7%. So this is data points that lets you know how the strategy does and all of the individual data points of the strategy. On the right-hand side here, you see these plus and minus values. These are essentially how this strategy compares to the previous test that you ran. So I had run a test previously. I almost want to refresh. Actually, I'm going to do that. I'm going to refresh this real quick. And I'm going to go back and rerun this test so that we don't have those data points, because I really want y'all to see. Ah, shoot, I got to rewrite it. I thought I had it saved. I didn't. Let me rewrite it real quick. Sorry about this, you guys. Cross down on indicator exponential. We'll change all these values real quick. 8 to 21. 8 and 21. Cool. Go to 3K. All right, so it's going to run this test real quick. So when you first run a test, you will not see that secondary data point that lets you know how it changed. But what we can do, let's say you have a strategy and it doesn't perform all that well, and you want to adjust it in some way. Let's say, for example, we wanted to add a take profit. Let's say we want to get out if we make 10%, or actually, let's say 12.5. Right? We can run this test and it's going to give us a new performance of the strategy, and it's going to tell us how it compared to the previous test. So as you make your changes to your strategy, it's going to let you know, the platform is going to automatically let you know, this is where you did better, this is where you did worse, this is kind of what stayed the same, right? So we could see our net profit went down by 367%. Our max drawdown went up. Our average win went down. So by making that adjustment, we just kind of shot ourselves in the foot, right? We didn't help the strategy in any way. Knowing that these values are here is kind of the point of this. I want you guys to understand mostly what these values are, and also how the new values that you're getting on the right-hand side are what they're saying. So if you have these decreases in performance, you can immediately say, yeah, no, that was not a good idea. That's clearly not the way to go. I could change things. You know, I could say, like, I want to buy the 821 cross up, but I want to get out if the 20 crosses down on the 50 or something, right? By making these adjustments, you are getting new data points, and you're comparing the new data points to the old data points. The last piece I want to show you guys is on the right-hand side. You're going to notice every once in a while these data points are outlined or they're highlighted in a red color. And what we call this is no-go highlighting. And what this no-go highlighting, oh, Robert, I'm sorry. What I did on the first one, I added a take profit of 12.5%, and that brought my results down. So I removed it, and what I changed this time is I just made my exit a different EMA cross, the 20 crossing down on the 50. I'm entering on the 8 crossing up on the 21. I'm exiting when the 20 crosses down on the 50. So using longer term moving averages to get me out. Short term moving averages to get me in, longer term to get me out. And so I could see how this strategy compares to the previous one, the one that had the stop loss. I've regained some of those profits that I had lost, but I've got this red highlighting over positions, and we call this red highlighting no-go highlighting. And what this no-go highlighting does is it alerts you to things about your strategy that might not work for it in the long term. So you may see this 557% gain, and you might go, yeah, that's great. It doesn't beat the asset. However, it's great, and it performs well for me. I'm happy with this. My average win went up quite a bit, 19.5% win or average gain on this particular strategy. On the original strategy, this value was like 13%. So my average win rate my average win percentage has gone up quite a bit. And you might be stoked on these results. My win rate actually went up. It's at 55 on this particular strategy. It was at 42 before. But my positions have a no-go highlighting. So why do they have a no-go highlighting? If you hover over it, it says sample size is way too small. It's less than 50. So in theory, the metrics that you're utilizing here for your strategy have not been back tested enough. There's not enough historical data to point to your strategy and say, hey, yeah, that's actually a really good strategy. You should use that in the long term. And that's the purpose of no-go highlighting, is to alert you to things about your strategy that you might not have seen because you were noticing an average win rate or an average win percentage that's actually quite high, or a percentage win rate that's actually quite high. 55% win rate here, that's a pretty high win rate, especially if 55% of the time you're making 19.5%, whereas 45% of the time you're losing 5.61. So like your risk reward is quite good on this particular strategy, 3.5% or 3.5 risk reward. So that's the purpose of the no-go highlighting, is to alert you to things about your strategy that might not be good longer term. I just wanted to take some time and spend with you guys on that. I think it's like a super, super powerful tool. I know it's a super powerful tool. I'm going to give you one quick little thing to play around with. And this is what I was playing around with earlier. Anybody who is interested in VWAP is probably also pretty familiar with anchored VWAP. And something that I was playing around with earlier today was testing just buying when price is above the year-to-date anchored VWAP, which means every single year on January 1st, an anchored VWAP gets anchored, or a VWAP gets anchored to the first candle of the year, and then it trails it until the last candle of the year, and then a new one gets anchored. So as long as price is above that anchored VWAP during the year, we're long. And as long as price is below that anchored VWAP during the year, we're short. I want to talk you guys through very quickly how to script it so you can see. We're going to say condition, and we're going to say price close is greater than. We're going to go to indicator. I'm going to type in anchored. And we're going to select the Alpha Trends anchored VWAP, comma, line. And in here, I'm going to select this. And I'm going to anchor it to, I'm going to choose the anchor to point and select year to date. And then the last thing I'm going to do is I'm going to put it in continuous mode, which means that every single year, it creates a new one. Very important piece. You have to have it in continuous mode. So I'm entering when price is above, when price closes above the year-to-date anchored VWAP. And then I'm going to exit when price is below it. So we'll say price close, less than, indicator, anchored VWAP, line. And then again, same deal. We're going to anchor it to the year-to-date, and it's in continuous mode. So I'm going to look back 7,000 candles. And we're going to go long and look at these results. This is really exciting to me because this is the first time I've personally ever found a strategy that beats buy and hold on Apple. So if you look at the performance, 93,000% gain versus the asset performance of nearly half that. Simply just buying when price is above the year-to-date anchored VWAP, selling when it's below, yields you almost 2x the return of just buy and hold on Apple. That's insane. What I want you guys to do, if you're interested in doing it, if you want to play around this tool, take this idea and run with it. You just learned how to script this. Take this idea and run with it. Try it on different names. You can, if you go to your sidebar, say add or remove. I'm just going to remove all these guys. And I'm going to turn on a watch list. And as I go through symbols, it's going to automatically test that symbol for me. All I have to do is click through my list. And you're going to see some symbols perform really well this way. Some do not perform well at all. AXP or AMGN, very clear. Doesn't perform well at all. 39% gain versus almost 3,000% on the long term on this particular name. So play around with this.
Stop filled.
I think you guys will have a lot of fun with tooling around with this. You guys might really find some cool things to do, and you might find a way to like take yourself completely out of your trading and let the machine kind of do it all for you. TrendSpider has a bunch of tools built to help you do that, to help you take these ideas that you come up with, turn them into trading bots, and just let them run for you. Super, super powerful. So hopefully you guys found some good in that. Hopefully you guys learned a little bit of something. I'm going to jump out of here. I really appreciate y'all being with us today. It has been a pleasure hanging out with you guys. I hope that you traded. I hope that things went the way you thought they would go in the markets today with Jerome Powell. Again, we've got Apple earnings tomorrow. We've got Google earnings tomorrow. We've got Amazon earnings tomorrow. I'm going to be on Twitter Spaces tomorrow afternoon. If you don't follow TrendSpider on Twitter, go ahead and give us a follow. I'm going to be on Spaces chatting with a bunch of folks about those particular companies' earnings results. I'd love for y'all to join us. And again, if you have not yet, please give us a follow here. Subscribe to the channel. Give us a like. Hook us up with all that good stuff. The more you guys do that, the more we can do these sorts of things. So I would love to do them as often as possible. All right, y'all. I'm going to get on out of here. I hope you have a great rest of your day. Happy trading, and we will catch you next time. Bye.